All right, we are back with more housing market data. We have an article out of Resi Club that says the Goldman Sachs Chief Economist thinks that housing affordability is so strained right now that existing home sales are going to remain suppressed through 2026. So he covers their economic forecast, where they anticipate the federal funds rate to go, where they think the 10-year Treasury yield will be, and where they believe home prices will be through 2027. You're not going to want to miss it, but before we jump into it, press that like button, consider subscribing, helps grow and promote the channel, and I do appreciate your support. All right, so jumping into this article, Jan Hatzius is the chief economist at Goldman Sachs. They now expect that the Fed Chair Jerome Powell will start to begin announcing rate cuts as early as Q3 of 2024. Now, they pulled their prediction forward. Previously, they anticipated rate cuts coming into Q4. That's no longer the case. In fact, the market is no longer pricing that in either. The market, rather, is anticipating rate cuts as early as Q1. In fact, if we take a look at the probabilities here, we're on investing.com right now, and we take a look at the first meeting in 2024. The probability is at 83.5% that the rates will remain unchanged between 5.25% and 5.5%. But as early as March 20th, the second meeting going into 2024, the market is pricing in with about a 72.8% probability that rates will be 25 basis points lower. Going into May, they're anticipating 50 basis points lower with 70% probability that the rate will now be 4.75 to 5%. And then as we go into Q3, the market is pricing in about a 60% probability that the Fed funds rate will be between 4.25% and 4.5%. And then by the end of the year, the very last meeting the Fed is going to have in 2024 on December 18th, the market probabilities, what they're pricing in is rather shocking if you ask me. There's a 37.5% chance that the Fed funds rate will be between 3.75 and 4%. And there's a 34.1% chance that the Fed funds rate will be between 3.5 and 3.75%. So the market believes the Fed has pivoted. They are starting to price in the probabilities that there will be future rate cuts here moving into 2024, and pretty substantial at that. Now back to the article, let's look at their economic forecast. So right here for 2023, this was their preliminary projections. They're anticipating real GDP at 2.5%, unemployment to remain hovering around 3.7%. I think we're a hair higher than that now at about 3.9, but we're still under 4%. So that's pretty close. The CPI is at about 3.2. That's about spot on. With the 10-year Treasury yield, they were anticipating would remain at about 4.75%. Or if this was made in the beginning of the year, it would go down to about 4.75%. Now, on that note, since this was written, the Fed had come out and essentially pivoted, or at least started the conversation about potential rate cuts moving into 2024. And that really stirred up a lot with the 10-year Treasury yield. And if we take a look at the 10-year Treasury yield, right now, we're actually sitting at 3.846. This is a major leg down here over the last 2 months. And if we take a look at their original projection at 4.75%, we're nearly 100 basis points lower as we stand right now. Moving into 2024, the real GDP they anticipate is going to be going down a little bit. They foresee unemployment rate essentially staying flat. In fact, they see the unemployment rate remaining at about 3.7% through 2027. They see the CPI coming down closer to the Fed's official inflation target of 2%. They're expecting basically mid 2% range going into 2024 and all the way through 2027. And then they anticipate the average 10-year Treasury yield is going to be hovering around 4.5%, which of course it very well could. However, we are trading below this at the moment, as we just saw. Now let's assume that Goldman Sachs nails this call. That would mean that mortgage rates ultimately would stay elevated here for the foreseeable future. The current spread between the 10-year Treasury yield and 30-year fixed rate mortgages is hovering at about 285 basis points. And if the Treasury yield's at 4.5%, that would translate to about a 7.35% average 30-year fixed rate mortgage. If the spread were to normalize and go back to a more historical norm of 175 basis point spread, that would mean mortgage rates would go down to about 6.25%. At the time of this recording, we know that the 10-year Treasury yield is sitting at 3.846, and mortgage rates have already fallen. This right here is a chart of the average 30-year fixed rate mortgage and the 10-year treasury yield. So right now, the average 30-year fixed rate mortgage is sitting at about 6.61%. With the 10-year where it is currently trading, this is about a 276 basis points difference. So if the 10-year were to, let's say, remain at 3.846, roughly where it is today, and the spreads were to normalize at about 175 basis points, we would see mortgage rates right in the mid to upper 5% range, which of course would improve affordability from where we are today. All right, now let's talk about the housing forecast that Goldman Sachs sees moving through 2027. Well, they expect housing starts to remain at about 1.3 million, going on up, a steady climb, if you will, to about 1.5 million. They see new home sales rounding out the year in 2024 at about 723,000, and then ending 2027 with about 858,000 sales. This data right here is very interesting. Existing home sales, their initial projection for 2023 was nearly 4.1 million transactions. We know now that it actually ended up around 3.8 million. And they anticipate that 2024 is going to be very slow for existing home sales as well, coming in at about 3.8 million, and then starting to climb steadily, ending 2027 with about 5 million transactions for existing homes. If we look at this existing home sale chart here, just to put things into context, this is where we are today at about 3.8 million transactions. And if you look at this chart, historically speaking, this is the lowest level that we've seen since the GFC back in 2008, 2009, and 2010. And then prior to that, going back to maybe the mid 90s. So this has definitely been a major crash in transactions. Just a few short years ago, we were doing over 6 million transactions. Goldman Sachs does not expect a meaningful recovery until 2027. So in other words, things are just going to stay stagnant and sort of just chug along, grind along here for the next few years, at least according to their projections. Additionally, their existing home sales prediction is a little bit more on the bearish side. In fact, Fannie Mae expects existing home sales to come in at just over 4 million transactions in 2024, while the MBA, Mortgage Bankers Association, is anticipating 4.4 million transactions next year. All right, now let's take a look at where Goldman Sachs forecast model expects U.S. home prices to go through 2027. So Goldman Sachs, they expect U.S. home prices as measured by Case-Shiller to rise 0.6% in 2024, essentially staying flat. So they don't anticipate a down year. They're not anticipating much price appreciation, but they are expecting it to stay relatively flat, maybe go up marginally from where we are right now. In 2025, they're expecting a 3.8% home price appreciation. In 2026, they're forecasting 4.9%. And then in 2027, they're expecting a 4.9% price appreciation. So you can see this little dip here where we were in 2023, where prices came down, they stabilized, they flattened, came up a little bit, and then they're anticipating us to see another run up in price appreciation. Keep in mind, if Goldman Sachs is correct, and home prices on a national level rise by a slim margin, 0.6% in 2024, it would likely mean that several regional markets actually see year-over-year price declines. Not all of them, of course, but some, and that will ultimately keep things about flat on a national level before we start to see the market tick back up again going into 2025. Now, of course, you have to take all this with a grain of salt. It's great information to be aware of, but it doesn't take into account things that have meaningful impacts, or at least can have meaningful impacts on the market. Things like recession, the unemployment numbers, black swan events, and things like that. And they're always updating their models here. So just stay alert, stay aware of the data and what is taking place so that you can make educated decisions moving into the future. And that's going to wrap up today's video. I hope you found this information useful. If you did, please hit that thumbs up button and consider subscribing. It helps grow and promote the channel. And I appreciate your support. Take care.